The real challenge once you get to the point where you're like staring at actual financial freedom is the question of, well, what is enough?
If you're a real estate agent earning $200,000 a year and you want to grow your passive income, this show is for you. Learn secrets other agents use and hear from experts in our field who will guide you on your journey to investing in assets like apartment communities so you can take your commissions and turn them into cash flow. Here's your host, Randal. Let's dive in.
Hey there, welcome back. It's great to have you on today. I am having a conversation with Spencer Hilligoss. He's the CEO and co-founder of Madison Investing. They live out in the Bay Area, and I say they because it's he and his wife that run this company. But he has a background in tech, and so we talk about him running businesses and that sort of thing. But we really start the conversation talking about family, and it's a really good conversation. He has some great advice about setting goals and how to set those goals and how to go from point A to point B. And so we just dive into that a little bit. At the end of the show, we talk about his investing and how they have structured their investing with sponsors that they invest with, how he got into it with as a limited partner and all of that. So it's a great conversation. I really enjoy the candid conversation at the front. So let's jump into the conversation with Spencer. Here we go. Hey, Spencer, welcome to the show. It's great to have you on. I am excited for this conversation. Like I said a second ago, I was digging into what you and your wife are working on and the business that you guys have grown. So again, it's always great to have somebody on the show who's got the experience, walking the walk, they're talking, so thanks for coming on.
Absolutely.
I want to start with what you had just mentioned, right? You said you grew up in a household, your dad was a real estate professional. And so kind of walk me through that process and how that impacted your thought process on wealth generation and anything else that you can cover on that front.
Yeah. And I appreciate you going there, Randall. I know we were talking offline about it, but this is the growing up in a real estate household to then become a guy who was a 13-year tech company, leader, formerly as a reluctant punk rock metal playing band kid.
All right.
Thought I was going to get into business in the first place. It's a fun journey that life takes you on, right? And now after the tech career, these days, I run a private investing group, where we invest in big, boring stuff that I love a lot. But it started off growing up, my dad being a broker, and I was put to task to clear out fridges and properties that he was going to sell. I was doing open houses before I really knew how to put a tie on. And I didn't want to be there, that's for sure. But those experiences taught me so much. And so I watched my dad build this business to great heights. This is in the 90s, which feels like a long time ago because it is now. I get more gray hair. But I think I look back at that experience and watched, wow, as a young teen and then into my 20s, like the lifestyle of our family with this one source of income, right? Transactional income, broker income, created an incredible lifestyle. They live out here in the Bay Area, and that's not easy. The price points are crazy high. The lifestyles are crazy high. The cost of living is brutal. And all that to say, there's this, not to get too heavy too early in the discussion, Randall, but like there was a kind of a dark decade, as we call it in the family, that transpired when younger brother, this is 20 years ago, younger brother got diagnosed with cancer. He passed away many years ago. And then, lost 3 grandparents shortly after that. There was just a bunch of dominoes that fell. And as a result of all that around that time, that one income, that one broker income that my dad was building from his business significantly reduced for all the reasons that happens around personal tragedy in life. And going through that for our family, family downsized. And I look back at that experience now. I'm a dad, I have 2 young kids of my own. I run our business with my wife and co-founder Jennifer Morimoto. She's the COO. It's a separate podcast for those that want to build a business with your spouse. I love it, not for everyone. But all that to say, like the clear lesson is this, anyone that's read the Purple Book, Rich Dad Poor Dad, they've heard the analogy of you got to go figure out a way to change from carrying those figurative buckets, those one dump at a time of cash flow coming in from a big transaction you worked your butt off on. Same thing could be said for working a W-2 job, which I lived and breathed for 13 years, making great W-2 income. You got to change from that somehow to go over to building a pipeline, and that book, as it's impacted so many people, was the first one I picked up when I got nerding out into real estate investing, of course. Profound lessons there. But watching it happen that way, now looking back through that lens, and my family and that challenging time, I'm like, how could that have gone differently? Right? Like, how could that have gone differently if there was a financial moat, if there was more than one income stream, if there was a way to go and say, let's build out 5, let's build out 10. So I've taken those lessons. I'm a slow learner. I applied that, leaving my 13-year career after working at 5 companies, making great W-2 income, maxing out 401ks, and sitting there in around 2016 while working full time. Jennifer's making great income, W-2 in her own career. And we didn't really feel like we were getting ahead. And I was sitting there going, well, where does this stop? Like I was grinding it out 80 hours a week in a tech company, early stage tech company. Hadn't seen one of my sons in over 2 weeks because I was going in too early and coming home too late. 401ks wasn't going to change our lives. So something had to give. And I was fortunate enough to get into a lender that was also a tech company, biggest fix and flip lender in the country, not knowing what the heck loan origination even meant. Kid you not. And I was tasked with turning around and growing a team there for loan originators. So without going deeper into that, I'll just say it was during that period of time where all the light bulbs hit, all this, all the sparks to ignite the fuse, whatever analogy you want to bring. That's really where it clicked, is when I was working in the guts of this fix and flip lender that was doing 600 loans per month. And I saw so many of the mechanics that made it be like, okay, there's more to real estate than just brokerage. It's the most well-known, right? It's a vital part of everything that happens out in the world. But all that to say, there's a lot more to investing, and there's a lot more to real estate than just the transactional income. And sure as hell, more than one income in a household is what we're going for now. And that's what we've built over time.
Yeah, that's fantastic backstory. I appreciate you sharing that. It's one of the things, like when you read that book and you become aware of, like, let's buy some assets, let's buy some streams of income essentially and build those things over time. I mean, it's just like a light bulb went off for me when I first read that. You mentioned something and you said build 5 or 10. Build 5 or 10 what? Are you talking about income streams?
Yeah, income streams, from various sources, just different ways of getting cash flow.
Yeah. Yeah, I just wanted to clarify that. And before we move off of the topic of family and that sort of thing, you have 2 kids. I have 2 kids, and he's 7 and my daughter's 4. And nice. I often am thinking, even just the other day, he wants something. He wants to go buy something. He wants to go do whatever get a game or something, whatever it is. And yeah, we can buy it for him and give it to him. And we have probably too much, but he's at the age now where I'm like, okay, I've got to start teaching him about money and showing him, how to earn money, go start a business, I've looked at alternative education styles as well, of going out and actually having kids in these other types of programs, not just traditional school, where they will teach them business. And like, they have to go, like, one of their main projects is, create a company, go get a table at a fair, you got to sell this thing. And, it's like intense sort of stuff that the young kids are doing. And they're fully capable of doing it. So anyway, I say all of that to take it back. The lessons that you have from your family growing up, the things that you saw happen or not happen, how are you now teaching your kids, or are they at the age yet where you're teaching them financial literacy, investing, that sort of thing? Are they out, painting a unit in one of your projects? It's like, I got the labor force, guys. Don't worry about that line item's going to go away because I got 2 kids who are going to go out and paint it. But are you doing anything like that to start that education process for them?
My goodness, I didn't know you were going to go there, and I'm so glad you did. Like, it is one of the most inspiring things to think about for me and Jennifer. So our guys, we have 2 boys, 10 and 6.
Okay.
And so I would simply say that, yes, in our own version, we've started. And I'll give a couple of things just for context. Financial literacy is a passion point for our household. And to the degree that Jennifer, my co-founder, COO, and wife, she is, like, for example, on the board of a Bay Area nonprofit that focuses specifically on youth financial literacy, right? And so, like, from that to something as simple as, at the dinner table, like, having conversations on a regular basis and intentionally lacing in these conversations, because that's really where, simple as it sounds, that's where a lot of the magic happens, and all the screens are put away.
Yeah.
And you could talk about these small moments, and these small moments include, hey, can I go buy this digital item when I'm playing Fortnite, Dad? And exactly. That's the catalyst for getting into, okay, well, how do you want to pay for that?
Yeah.
And it's those little moments and then occasional big ones. I mean, another one I'll share. So we just got back about a week and a half ago from living in the Balkans for 5 weeks. That means like Croatia and Montenegro, whole family. And it's not a vacation. I mean, like, we're living there. So that means the kids are going to an immersion school. We're also managing our business, and we're doing some investing stuff while we're there. And last year we did our first one of those. Didn't know how it was going to go. We did Portugal last year. So I bring that up because exposing our boys and even ourselves to more scenarios that are outside our comfort zone And I know that maybe that sounds like really lofty and lavish because folks are sitting there thinking of sitting on the beach with a Mai Tai. It's like, no, we live frugally as best we can, right? Like whether it's the cars we drive that are used or it's traveling internationally, we're not going and staying at five-star hotels. But that is a 100 different conversations day to day with the kids, and you're out there in a different country looking at different currencies, like I could go on and on, but I just wanted to bring that up because never could I have imagined having the opportunity and the presence of mind even to get into these types of discussions in our household with our boys. And so I think that it really comes down to the small day-to-day moments as the strong foundation and occasionally exposing them to bigger conversations like, oh, why are we flying in coach and not doing in business class? Like, well, gee, I never flew business class ever. It's just so.
Yeah, I'm like, guys, I didn't even fly until I was 18 or something. That's the conversation we have in my house.
Yeah, man. Well, and something as simple as like, hey, how come we haven't gotten a new car in so long?
Yeah.
Right. And that's it. Like that is where the rubber meets the road. And in my humble opinion, every family is different, every household, every conversation with a child and a parent. But yeah, sorry for the diatribe.
No, I mean, honestly, I had this conversation. It only comes up once in a while when I'm talking with people and chatting with people. But I mean, it's relevant. Your kids are a little older than mine. And so I'm always kind of curious because I'm constantly, I heard it was, I think, my first million or something the other day. They were talking about, it was on that podcast. They were talking about their kids and how one of the dads, or no, maybe it was Brandon Turner's podcast. That's what it was. One of the dads he was teaching his kid about Lego, about business in general, right? And the kid wanted to do Legos, and he's like, okay. And so he bought Lego set. He lent him the money. This is how he structured it. He lent him the money for the Legos. The kid had to build them and pay back the loan, right? Pay back the loan meant he had to basically refinance or sell it with his dad.
Yeah.
So he built this Lego set, and since it was complete, it was more valuable. And now he could sell it back to his dad for 1.5 times what he built it or borrowed for. And I was like, oh, that's genius. That is amazing. But, just finding little things like that and hearing little stories where it's like, okay, I can teach money. I can teach them this process. So anyway, I love that.
That's a great one.
Yeah. I mean, the guy is Indar. I forget his name, but he's a big investor that, you might see some of his stuff. But anyway, going down a rabbit hole there. So the other thing I want to talk about, because you just mentioned it, is living overseas for 5 weeks, right? So my brother he went and did that in Costa Rica last year. They spent 4 or 5 weeks and did the same thing. Kid was in immersion school while they were there, and they were working, doing the thing. But you obviously get to visit and see some things. A friend of mine just got back from Montenegro. She loved it, had a great time. She was showing me pictures. Beautiful there. So yeah, seems like a beautiful place to be. How, again, you have these lessons. One, why did you guys decide to go and spend 5 weeks overseas? And then how did you structure everything on your business side in order to be able to do that? Maybe that might be a long-winded answer, but if there's
this is the fun stuff. Frankly, like I really appreciate this discussion, and I'll try to bucket into the 2 categories so it's easy to digest and I don't just ramble. So how did we do it? First and foremost, like I think, well, why did we do it? The why, we were sitting there 3 years ago now, before we did our first trip. Last summer, we went to Portugal for 6 weeks. And we got to a point where we were sitting there going, okay, our business had taken off faster than we expected. Our investing had gone extraordinarily well, courtesy of 2021 in particular. I think we got into a lot of deals in 2016, 2017, 2018, and 2021 was one heck of a year when it comes to valuation spikes. So we had 13 exits, I think, between those years on larger deals we'd invested in between apartments, self-storage, et cetera. So it was a good run. And so we were sitting there going, on the other side of those moments, never could I have understood this stuff back in the day when I was working full time. But like the real challenge once you get to the point where you're like staring at actual financial freedom is the question of, well, what is enough, right? Talk about like the unanswerable human condition problem, right? Like I don't have an answer to that. It's such a personal answer. I'll be chasing that answer for the rest of my life and everyone else will. And so to that end, we were sitting there 3 years ago going, how do we ensure that we continue, like we've worked our butts off to get to this stage from the wealth perspective, from the passive income perspective, et cetera. What are we going to do about it? Like what are we going to do with it? And the commitment to ourselves was like, well, we did this. The number one reason we did this and walked away from high paying jobs and careers was because we want to shift our priority order. If you just looked at my calendar, like if someone asked me 10 years ago, what's your priority? Well, it's making sure I have a great marriage, and eventually when I had kids, I want to be a great dad. My calendar activity did not reflect that. the hours spent, where my time was going, what I worked on first in the day. It didn't reflect family enough. It didn't reflect health enough. And I'm very comfortable saying that because I think a lot of people can relate. And we sat there and just said, how do we materially push ourselves outside our comfort zone, despite as scary as it might seem? Because I know some people are, globetrotters. They're happy to get on the plane. They're happy to go to another country. They're very comfortable, multilingual. We've been around the US a lot. We've been to Hawaii. I've been to Mexico a bunch of times. And I've been to Europe, but I've never been traveling with kids like that. And so we just sat there and committed to ourselves and say, book it, book it and get it on the calendar. It'll hold us accountable to two things. It'll hold us accountable to a path that we know to be true and the right one, putting family as the priority, health as the priority. It'll also ensure that anything that we build for the future work-wise must be built around that.
Yeah.
Sounds so simple, right? It's so much harder in practice.
Yeah.
But I think to your second question, if that was the why, I think the how on the business stuff is making some decisions early on that are really hard. It's simple sounding, but hard. When I first got into, this is brief, but I look in hindsight, like this is a clear-cut thing. It wasn't, but there's like three phases if I were to describe our journey through passive investing, right? Or buying property. Phase one, we were working full-time, was too scared to buy a long distance. So we drove around all summer, bought one duplex in the Bay Area, paid $430,000 for it, put $100K down for $200 a month in cash flow, which is a total whiff, right? It's like
crushed it.
Crushed it.
Maybe on the appreciation side, but yeah.
And to be fair, it has crushed on the appreciation side. Yeah. However, that wasn't the goal for the money.
Yeah.
Which is expensive tuition, So we had car seat in the car with one parent staying in the car, the other one swapped in to go do the open houses, to go take a look at these properties for that cash flow all summer for one property for $200.
Yeah.
Phase two, we got comfortable long distance. We've got a portfolio we built up to 5 single family rentals in the Midwest, 60K a pop. And on average, which is mind blowing to me, right? So to West Coasters, people in those pricing markets, that's mind blowing. For $250 on average a month in cash flow, which is killer. But then we realized that rentals are semi-passive at best, and it's not a condemnation. Like rentals are still great if you know how you want them to fit, like in your life, in your portfolio. But all those experiences led us to go passive, and I think that this is all leading to phase three, which is how we put together a business we could run more remotely. And that's investing as an LP, limited partner in private funds and syndication, large deals. And that's how it started, man. We, put 25K into our first one, like a big apartment building in Alabama. And then we did a lot more actually in your home state. That's been like our primary focus, has been particularly in like Dallas, Dallas, Fort Worth, and other markets as well. But we started investing chunks of our wealth, and we got some of that wealth from our strong income. We got other wealth from, hey man, we bought a Bay Area property in 2013, and that was just luck. And then 4 refis later, we had some capital, right? And so I'm grateful for that run, but we're able to start putting some chunks of capital into different deals. And then it went extraordinarily well. As it went well, we built an investing club around that. And there was a moment where I was about to get really active, and I asked the mentor, I was wrestling. Do I want to go be the lead sponsor on buying a 10 unit, a 20 unit, a 100 unit apartment building? Do I want to be the lead GP? And he asked me the question of like, what kind of state do you live in? I'm like, what? What do you mean? He's like, do you live in a money state or a deal state? And I was like, oh, well, that's pretty clear cut. And the real question was, as a guy who used to live in Colorado for 10 years, as an example, I'm not tied to California for some pride reason. I would say we have roots here now with our kids in schools, et cetera, but I wasn't moving.
Yeah.
And so we built a business around where I would plug in and partner with people who were the boots on the ground based in these other markets. And we would look for the best. We would look for the excellent teams and take our time, get to know them, vet the heck out of them, put our money in with them. And if it went well, then we would start taking a look at their deals. And we would partner up with them and share those deals with our investing club. And the club started as something small. It became something much bigger. And now it's my primary focus professionally.
Yeah.
So it is possible to do it mostly remotely, unless I'm doing due diligence, which means I fly to the properties and walk them and meet with the team, et cetera. But I'm not doing that literally every day.
Hey everybody, Randal declared here with a special shout out to our friends over at Invone. If you're looking to diversify your investment portfolio, you've got to go check them out. It's invone.com. It's a crowdfunding platform with a wide range of investment opportunities things like real estate investing and even bourbon barrel investing. So check them out. Invone hosts our crowdfund. It's actually a single family real estate investment fund that we have launched with them. And we've had an awesome experience working with Levy and his team. They're super responsive, very quick to assist us with things that we need. And they have crowdfunding down to a science. Go ahead and check out episode 154, where Levy and I discuss crowdfunding in detail and how it can help you either invest or raise capital. And check this out. As a friend of the pod, launch your crowdfund with Invone, and you're going to get an exclusive 10% discount when you head over to invone.com/ABC, or simply call Levy and his team at 475-800-8716 and mention Agents Building Cashflow. Go crush it. Happy investing. Talk to you later. Yeah. I want to jump into that in a second. You said something else just a second ago, and last question kind of on the family, on the why, on the just personal more so than business. But you said something like you wanted to reprioritize your focus with the family, right? Yeah. And you were in a position financially to be able to shift things around to focus on family first thing in the morning so my only question would be, you've got somebody who's not as financially fit as you were in the moment where you're able to make those decisions.
Sure.
What advice would you give to them? They have a family, they still want to spend time with them. Like how, it's a philosophical question. So it's very, absolutely. I don't know if you have advice around it, but like, what would you tell them? Like, I don't have enough money to take the time to not be working at XYZ a time when my kids are needed, or so that I can spend time with them. Like,
right.
What would your suggestion be they do?
Absolutely happy to speak to this. It's going to be much simpler than I think most folks imagine. And this was my journey. This was like literally what I did.
Yeah.
Speaking from experience. Is that going to work for everyone? Each person out there knows themselves best, right? Here's what I had to do. I was working, when I started to build our business while working full time, I was leading teams of people. Like I had a very demanding day job. So step one, and everyone wants to skip this step. I wanted to skip this step. You cannot skip this step. Otherwise, if you skip this step, it ain't going to work, in my opinion, which is you need to set a goal. If you're married or would have a partner, you got to set that goal with them. So Jennifer and I got a sitter. We sat down, took a whole weekend and said, let's put down on paper how much we have now, how much we make now. Let's also then set a from to. What is the passive amount of income we want to get from investing on a monthly basis, simple cash flow number, and by when? There was tears, there was reconciliation, there was laughter, there was every range of emotion you can imagine. And that's not to scare people from doing it, Randal. It's in hindsight, it felt like what was needed for an honest answer that we both believed in. And the irony is, like, we walked away from that first weekend of two with like, our goal was let's hit this dollar amount of thousands of dollars per month in 15 years. And it sounds like a long time. It's way, way longer than people want to be able to say that they're going to be patient to go and grind, right? Yeah. The next weekend, we chopped that thing in half and it came down to 7. Yeah, nice. But we hit it in 5. And we hit it in 5 by doing this as a starting point. I audited my calendar. And that means like literally going through every day of the week, including the weekends. And I said, where is my time going? Okay, working hours covered here. Can't carve that out to build another business while doing my day job. Yeah. Where can I borrow time? And I put away the Xbox. I love playing guitar. I put away the guitar for 2 years. It was about sacrifice to make more time to free up what equated to 10 hours. 10 hours per week is what I found. And I also am not a night working. My brain turns off after 5. I'm also not an early guy. I don't naturally wake up at 4 a.m. like a lot of folks talk about cold plunging on social media. I'm just not that guy. But for the right reason, like when the goal was set, and this is why that goal step could not have been skipped for me. It's too hard to do it without the goal.
Yeah. I
woke up at 4, I went from 4 to 6. So 4 to 6 was my work on the work before the work, yep. 5 days a week. And I read 24 books in an 18-month period. No one needs to go do that. That was procrastination after the 3rd book. But, listen to 400 podcasts like yours, like good education. And then I started networking like a madman. And, people who just want to invest passively don't have to go do all this stuff. I was trying to figure out how to go and compress the timetable in which we could hit it. And, and thankfully we, ended up working with it, but that was it. It's like clarify the why, make it time bound and specific, audit the calendar, get down to a number of available hours so you can remove the excuses, start doing the work. And make it sound like it just happened, but like there was so many disappointments and moments of excitement and things along the way. But at a high level, those are the steps.
Yeah, that's incredible. Again, take notes on that and go execute if you are in that position. And candidly, my wife and I have this conversation a lot. I've had this conversation on this show a lot where I'm like,
Yeah.
I ask her, the big question of how do you want our lives to look in 5 years, 10 years? And it's a hard conversation. It's a difficult thing to think about. But yeah, having that offsite as you and your wife did in order to, take the 2 days that you need to sort that out. Clearly it's paid dividends. So thanks again for sharing that. So, all right, let's talk some business. That's
Sure.
all the stuff that makes life worth living though. So I'm glad we went down that road and talked about that a little bit just to kind of understand a little bit more, how you got to where you are. So
Yeah, it's the most important stuff, man.
yeah. Lending Home. It's funny you mentioned them and I saw that on your deal. So you worked with Lending Home and shout out to Ray. I forget his last name, but he was out.
Oh,
Yeah. He was my guy.
Oh, Ray's a good buddy.
Yeah. So I may still have a line of credit or something floating out there with you guys. I have no idea. It was, we had it running for a while. I like the setup. You guys had a great setup. Are they still going? Is it still?
I think they're doing better than ever.
Yeah. Okay. That's, I was like,
but they, I think that a lot of ebbs and flows, and now they're called Kiavi. But yeah.
Kiavi, that's what it is. Yeah. No, I have a loan. I refinanced one of my properties with them, and then I had a line of credit for all our flips that we were doing. So I got to reach out to him. We're cranking things up.
Like I know we said we closed a chapter on the whole like build your business, the purposing thing, but one thing I have to mention is we're on the topic of lending home, et cetera. And I mean, a point of inspiration if folks are not quite there yet in their heads, like I left out a key point. A key point for me as a guy who, you do a job long enough, you do a career long enough, you tie your self-worth to it. You also tie your identity to it. That happens to 100% of people. And for folks that are deep into it, I was like a leader, right? I was a leader and manager of teams, and I grew teams, and that's what I did. But it changed a bit when I was at Lending Home because I was working my butt off. But then I had these kick-ass, amazing people that were reporting to me, and multiple groups of them. They were doing flips on the weekend. It's fine with everybody there. I'm fine with me. But there's a couple of groups that would work after hours, and they were building something, and they were building something after crushing it that day, like working excellently. And I'm sitting there going, okay, the lights are off. Like, why is that one room lit up and those guys are working so hard? And I watched them build something of true value, leave the job in a very respectful way with my excitement for them intact. And I was like, man, why can't I do this?
Yeah.
And sometimes it does require that extra oomph. If the goals don't get you there, seeing other people firsthand, who they are, what they could bring to the table, and then looking at yourself and saying, what's my excuse?
Yeah, it's one of those things where, I don't know, I talked to a guy locally here, and it is the seeing is believing. Like you see these guys, they're working, they did it, and then they exited and they went and did their own thing. And you're like, okay, why not me type of thing,
Absolutely.
Yeah.
Right.
But you got to give yourself the permission, I think.
That's a great way to say that. Yeah.
Yeah. And be able to go do it and have the confidence. Working with your wife, my wife works with me. We could certainly have a whole podcast on that and
no
support needed, I guess, and the struggles and the wins. But having her around, I'm sure that was beneficial and helpful. Having the support to make that jump as well.
Oh, critically helpful. And she's, Jennifer, to be clear, she is the operational strategic badass of the household and 1,000 other things that I can only, hope to hold a candle to. So
yeah. Same with the wife. Okay. Well, let's talk then. Okay. So you're out of Lending Home. You guys are getting into syndication. And I mean, it wasn't a terrible time to get started in that business, I would say.
Yep.
So you're riding this wave of, multifamily storage, cap rates are compressing, values are going up. And so, having 13 exits in 2 years. Is that what you said?
Yeah. I mean, grand total, it was within a range of about 4 years, 3.5, 4 years.
Okay. But so you're running through and again, you strategically set up in order to say that you wanted to be passive in these investments. You were looking at operators, you were going in across the country, was it? Or were you focused in one specific area? How did you guys start into syndication?
Yeah, it started out in focus on Dallas, frankly, like really just still love multiple Texas market now, but I think for all the reasons that you and I both understand at this point, which is, looking for Sun Belt largely, some of the Rockies, but the fundamentals of just saying, hey, business friendly, population growth, all those fundamentals, and, industries that are diversified, et cetera. So, we're in those kind of places. And I have been more active here and there on deals, like part of GP team, more active stuff. But, I think that largely, to your point, yes, I think over time we wanted to, add more passive and, not as much active.
Yeah. So did you start as an LP, or did you start straight into like a co-GP? I'm going to come raise capital, help you guys with asset management and that sort of thing. Or where did you start into the business?
Started as LP, just
Okay.
straight up LP. And I still think that is an excellent place for people to begin, just because you get to kind of try the product, and see if it's going to work for you. And so we started there. And eventually it became something where like you're out there networking with folks, and I'm just interested in finding great deal flow. And it's fun, like when you can truly get into this stuff and it becomes, no matter what the topic is in business, what industry you're in. But for me, this became like the hobby in addition to the passion, in addition to something I wanted to be excellent at. And so that was me networking like crazy. And eventually, we were investing in deals. I had a big network within the tech network, but also I think just the Bay Area. And so folks would say, oh, sounds like you did really well in that deal. How do we get in on that? And then to take a step further, like I had the expertise at that point from my tech career, like in leadership, and I knew how to do spreadsheets. I knew how to do business partnerships. I knew how to vet people because I'd hired hundreds of people, right? I mean, like I was leading teams of 200 people at the age of 26, not knowing what the hell I was doing, but learning the hard way. And eventually, over a decade, you learn how to vet people far better. You don't hit it 100% of the time because there's no one that can do that. But finding great sponsors and vetting deals and vetting markets and flying out there. People don't want to do that, but they do want to be passive investors.
Yeah.
So that was really the need that was very clear. And we built a business around that.
Yeah. So, okay. So you transitioned into building, are you fund of funds? Are you like, how do you structure your deals? Are you raising on a per syndication, per asset basis? Or what do you guys take it back one sec. I just still want a clarification. Did you guys start in multifamily storage? What was the first asset class that you guys invested in?
Exclusively multifamily.
Okay.
We were doing exclusively multifamily for at least the first, 7 to 8 deals.
Yep.
And then I think it was around 2019, late 2019, cash flow was getting thinner on a lot of the multifamily as, prices were going up.
Yeah.
And also at that point, people don't remember by comparison. I certainly don't, but rates were actually going up then too. They were cut down to zero very rapidly because of COVID. But for all those reasons, cash flow was thinner on multifamily. So we started looking at storage, and I'm so glad we did. Like, it is such a boring, wonderful asset class in the best way. So from there, it became half-half. We really started looking at storage in addition to multifamily at that point. Yeah. And I had been co-GPing. We have now evolved through a phase where it did a bunch of co-GP deals, but now, focused very much so on doing like occasional, pooling funds together of our own money in an SPV, like a feeder fund, to get better terms for a fund, and that's what we're doing right now. In addition to still looking at single asset deals with partners we really take our time to get to know and embed myself in their team. But it's just harder to find deals that pencil in the year 2024. So I think it's, scraping for that diamond in the rough.
Yeah. All right, let's talk feeder funds then, because I'm curious how you've structured it. And I haven't talked a lot about it on the show. We definitely have talked about funds, syndications, the difference and benefits of those sorts of things. So just explain what a feeder fund is and why you would use it and how it works for an investor or an LP coming into your world. Yeah,
happy to. So I would just think of it like, if I go and I want to invest 50K, 100K, something like that, and I found a great team. I found maybe they have a single asset deal, just a one property deal, or maybe they have a fund of their own with a bunch of deals. Either way, a feeder fund simply means that instead of going and just investing to get terms that are the retail terms, what if, the power of numbers, of pooling our capital along with, millions of dollars of other capital of fellow investors in our investing club, they all like this deal. And if we go pool that funds together, we can go actually secure better terms than you would get if I just brought my 50K, my 100K to that deal or to that fund. And so at a high level, that's really all there is to it. And so we all pool together and folks invest along with us in our feeder fund, which then goes and invests in a deal.
Okay. So is yours evergreen? Is it open-ended? How do you guys have it structured? Or is it on a per deal basis? Like you found, a 200 unit, class A building you're trying to buy. Then you stand up a fund specific for that operator and that deal. How do you guys have that structured?
Yeah, currently, given where the market's at, like the primary focus that we have right now is actually on private credit. So
Okay.
we put one together that's an open-ended, but it's not a mixed fund. It is on a per deal basis. In this case, a per fund basis. So we're investing with a great team that's out there giving like preferred equity, and mezzanine loans
Yeah.
to a very, very much needed problem, which is
Yeah.
all the bets pulled back. So there's great deals to be bought. So we're like, well, the current strategy makes sense to go become the bank more.
Yeah.
And so that's where we're focused right now. It really depends. I hate to be unclear, but I'd say it depends. I may join a GP team, right?
Yeah.
Like if a deal's good enough. And on an SPV basis, though, we're not necessarily putting together a blended big fund ourselves that we're going to allocate from anytime soon, perhaps in the future. But so right now, it's a deal by deal basis. We want the team to be great. And we want to be as transparent as possible with our investing club to be like, this is what we're investing in.
Yeah. Yeah, that makes sense.
The right time for that in the market.
Yeah, for sure. Yeah, for sure. I agree with that. So, all right. So then let's walk through some of, again, just for educational purposes, how this might come about. You know a sponsor, they have a great deal, and you guys are ready to put some money into that deal. What does that look like from an investor standpoint? What kind of, not just due diligence? Again, I was just telling you, I talked to Paul Moore just a second ago. We had this whole thing.
Sure.
We were talking about due diligence and how they vet their people, because they have it's kind of similar where they have a fund of funds that goes out and invests in deals. So how do you guys go? I guess, what is that process like as an LP coming into your deal where we're all going to pull our capital and go invest in this one project? What kind of better terms could we possibly expect? Doesn't have to be specific, but what do you guys?
Yeah. And happy to speak to it. I think, so 2 comments on the due diligence front. I think we have a 5-part vetting framework, which really, as a starting point, it's all about the who, right? And if you're passive, and this was a big shift, I know your audience is probably pretty sophisticated because you're talking primarily to folks who are already in the business, but just to say it bluntly, everyone likes to go focus on passive investments as looking at the numbers first. And that's just incorrect. You got to look at the team first. And the team, we have a 5-part vetting framework for. So we look at literally the team structure, and there's a bunch of spreadsheets, rows to back up each of these, of course, which I won't go into, but team, approach, which includes track record. You've also got communications, legal, and values. As corny as that sounds, you could test for that stuff behaviorally, interviewing wise, and a few other ways, and track record. But we look at all that stuff, and background, of course, all the basic stuff that everyone would expect, I would hope, which is like criminal, civil background checks, looking at their financial records, et cetera. Like that's all table stakes stuff for the who. So I just wanted to make that abundantly clear.
Yeah.
And it takes time. It's boring, but it's vitally important. And so in terms of terms, more favorable terms is actually pretty simple. I mean, it manifests in different ways, of course, on paper, but number one would be a lot of times some of these like really good deals or a fund might have a higher investment minimum, could be 200K. Like we've worked on deals before that had like a 200K minimum at the lowest end, and we negotiated like 100, right? And in the current one we have now, it's like, most folks, particularly now in 2024, I think they're more interested in a 50K minimum, so as opposed to 100 or 150 or 200. So lower minimum, that can be one of the things. Another thing would be most commonly what people are looking for, and I'm looking for, is a better split, a better waterfall and profit share. All those 3 things mean the same thing for all intents and purposes here. If you see a LPGP, meaning limited partner, general partner, passive investor, or manager interchangeably, as opposed to like a 70-30 for LPGP might be like a 90-10, right? It might be an 80-20. Those are the types of things that are interesting as soon as you can invest larger amounts together and with the power of pooling. And so, I would say that those are kind of the biggest levers. Typically.
Okay. Are you guys in a position where you require some sort of governance when you go into some of these deals if you're a big enough check writer, or are you staying below where that becomes a thing where you, let me back.
Yeah, we're not that big of a deal.
Okay, let me back it up and ask, when you are going into these deals, my understanding, and so this is an education for me, is that are you setting up again as a fund, so everybody's pulling capital with you, and then you take that one check and go, right? Is that correct? So
it's one check. So it's usually going to be, I think I hear where you're going. Like for example, right now it's a regulation D506C offering. So open to accredited investors, but we do have to ensure that they are meeting accreditation standards with a third-party verification. Yep. And you file a Form D. This is getting real dry real fast for people who don't want to talk about compliance. I'm going to put a bunch of very strong income agents to sleep here, but you basically registered with the SEC, you know,
Yeah.
you got to file your Form D, et cetera. So it's a offering that is called a 506C.
Yeah, no. Okay. So let me clarify then. I'm saying, are you structuring that 506C and then that your fund is then investing in that deal as a single
Correct.
check? Yes.
Correct.
Okay. So you said something, again, this is just for my clarification. You said something that you can negotiate lower minimums. My understanding is your fund, you could say whatever you want. You personally, if you're creating the fund, you could have a $10,000 minimum that is then investing into this other deal that may have
You could.
200,000. Okay.
You could.
Okay. But so you don't have to match the terms is what I'm getting at for whatever the lead
Correct.
sponsor has. Okay.
Correct.
Okay.
That's exactly
The way you said it, I just wanted to make sure that I was not misunderstanding where you had to go negotiate a side letter with them in order to get that lower minimum for your fund to be able to invest.
No,
You know
totally
what I mean?
appreciate you kind of guiding me through that with the follow-ups because this is a nuanced space.
Yeah. Okay. Okay. Again, that's for me. So I just want to clarify and make sure that I knew what was happening there. Okay. So you guys are putting in, and again, so you have these deals that are going through. Is there one thing, again, I love about the approach is that you get to look at a bunch of different sponsors. You get to look at a bunch of different deals and then you pick and choose. And so in this market right now, what are you seeing that is like one type of asset class that you are, geared up for, really excited about, or that is the best option,
Yeah. I mentioned it earlier, but I think that it's a unique moment in so many ways. Everyone who's following in any way interest rates will understand this clearly, but rates are high. They're still high. I believe they're going to still be high, although trickling down, I gave up forecasting interest rates, by the way, like 18 to 24 months ago. I'm not going to try to declare what I think is going to happen. There's my disclaimer. But I think we're going to start seeing a tapering of interest rates by the end of this year. However, the banking industry and lending industry changes very slowly. And yes, especially after the whiplash they experienced on the front end of this cycle. And so, long story short, I think banks will continue lending less than is really helpful to close transactions. And I'm talking specifically within like multifamily. The asset classes we still enjoy, commercial, excluding office, which is its own 10 podcast interviews worth. The nature of work has changed. But in terms of multifamily, industrial, self-storage, stuff that has great fundamentals, it's hard to get loans, right? It's hard to get loans. And so we're invested in private credit, looking at that. I looked at many different funds and players in that space over the course of 9 months of due diligence to find the current one we're working on now and partnering on now. And I think that is a space which is only going to continue thriving because it's hard to borrow money. It's hard to borrow a check of $1 million to $5 million within a capital stack to buy an apartment building. So I would rather be on the banker side of that when investing my capital. So that's the first one. Still looking at great deals, acquisitions as an equity investor. It's just really hard to find it. And I do think that de-risking those is different now. It's different because you have to put more down. Like what does it mean to find a great deal if you buy an apartment building that is truly at a discount? This is the positive side of high rates. It's like you're seeing kick-ass discounts when a property comes on the market somehow, right? And there's way fewer available when you buy them. If you have to put like 40% down, 50% down, it's not exactly easy to cash flow. So you have to find a deal with some kind of characteristics in a market that's doing well now that is not staring rent decreases in the face.
Yeah.
And that's a tough needle to thread. So we're looking for partners and deals that meet that criteria, in addition to ones that are very friendly for long-term holds and they like fixed rates and they want to do tax advantage structures. Without getting too nerdy here, I'll just say, always a fan of trying to invest in something that will have a 1031 on the exit as an option, because then you can defer a tax event, all that stuff. So yeah, it's a very nerdy answer to your well-worded simple question.
I kind of want to get nerdy on that. We only have a couple minutes left, but so how, again, on a fund of funds where you're coming into that deal, and are you allowing your investors to 1031 out of that at the end, and how? Because that's like 10 ticks within a tick of the deal.
I jumped over too quickly on that one. I mean, those types of deals we would probably be still looking at as like, I would be a GP.
You got it. Yeah. Okay. Got it.
Yeah,
so that you can
on the one-off deals.
Yeah. Okay. It's not part of what your fund is doing.
No, so, I wish I could do that, but it cannot do that.
All right, so on the personal credit side, are you talking about like pref equity type of investments that you guys are doing?
Yeah,
Okay, so
prep equity, mezzanine,
yeah,
occasional. But
what kind of returns are you seeing on those? Are we still 12? Is it gone to 16? Is it?
I mean, I would say that you're in the ballpark though. Yeah, like you're
Yeah.
right in the ballpark. I'm not looking for the investment thesis. I think is the wisest that I am putting my capital behind at the moment is one that we're not going for the 22 to 25% IRR necessarily across the board, like all of us could stare at on every PDF investment summary back in 2017 and 18. This is a different context. And this is a pretty damn unpredictable market that we're staring at, like geopolitically, election year, et cetera, and oversupply of a lot of these assets in some markets that no one really saw coming at the severity that they expected. So all that to say, I am very happy to take a 12 to 15% return, targeted return. Yeah, that caveat, targeted.
Yep.
And it's a more favorable position in the capital stack right now, as opposed to going for common equity investment as an example in a property that's assuming it can raise the rents 3 to 5% every year for a 5-year pro forma and banks on a refi in a tough lending environment.
Yeah. And banking on cap rate compression instead of,
Right.
Okay. Well, I mean, we could go longer. Spencer, I could talk to you about a lot of things. The front end of this, I really enjoyed that conversation, just talking to you about, structuring the family and the investments, the why, like how you structure your investment strategy. So again, I appreciate you jumping on, talking about that. If you're looking for investments and you want to reach out to Spencer, you can go straight through the links in the show notes. You guys can reach out to him and his team and look at what opportunities they have. So, man, again, I appreciate you jumping on, chatting through, but I think we should leave it there.
Yeah, what a pleasure. I mean, it's such a fun conversation, Randall. Thank you. And thanks for swapping learning on the childhood and parenting stuff. That's a blast. But yeah, folks can find us at madisoninvesting.com. And, I have a conversation with every person that wants to reach out. So happy to do so.
All right. Right on. Well, guys, we'll catch you on the next episode. Did you know that 80% of the agents we speak with got into real estate in order to gain passive income so they could obtain financial freedom and become work optional? If you want to stay up to date, the best way is to make sure you're subscribed. So if you haven't done that, go ahead and do it now. We'll catch you on the next episode.